Evening and welcome everyone to our first OptionsPlay education event as part of this new partnership between NASDAQ and OptionsPlay. Today, what I want to do is show you guys what we have to bring to the investors for tools, education, and ideas for trading Nordic derivatives. Now, tonight, what I'm going to do is give everyone a quick introduction to OptionsPlay. Many of you have already signed up and perhaps logged into your OptionsPlay account. So what we want to do is we want to show you, number one, how to utilize that platform, but more importantly, show you what you're actually going to receive coming up in the next few weeks, the next few months, and a brief introduction to actually trading options for those of you that are new to options trading, and make sure that you have access to the right tools to help you learn and hopefully eventually start utilizing options in your own portfolio. So as you'll see tonight, what I'm going to do is we're here to provide ongoing options education to Nordic investors. And today what I'll do is I will provide just a start to the whole program that's designed to help you learn how to utilize options for your portfolio. And the best thing of all of this is the fact that everything that I will show you here today in terms of tools, in terms of education, is all available to you free of charge, courtesy of NASDAQ. So let's go ahead and get started. Before I do, I just want to do a quick disclaimer. What we're going to discuss here today is purely for education and demonstration purposes. It is not an offer or solicitation to buy or sell any specific stocks or options or securities. So one of the things that I want to do before we actually jump into today's topics is I want to do a quick poll to get a sense for the audience here in the room. So what I've put up on the screen here is just a quick poll to ask you, what is your options trading experience? Are you brand new to options trading? Are you doing a little bit of learning? Or do you have some experience trading options? So if you could please vote on your screen to give us a sense for what your experience level is, that would help us better understand what type of education users need. Okay, so about a half of you have voted so far. I see a pretty even split here. About half of you either have no knowledge of options trading or learning how to trade, and about the other half of you are either experienced or have experience trading options. Let's give you a few more seconds to get some more votes. Okay, so it looks like most of you have voted here. So let's see. It looks like most of you have no knowledge of options trading. So for those of you that are brand new to options trading, welcome. This whole program, this education is really designed to help inspire and hopefully show you how you can utilize options for your portfolios and gain different use cases of options, whether you're looking to generate income, whether you're looking to speculate on the markets, or if you're just trying to hedge some exposure in your portfolio. These are all the different ways that we're going to cover in the next few weeks and the next few months to show you how you can utilize options to do all of those things. And for those of you that have experience trading options, the tool here is really designed to make your life a little easier. We want to turn your research from a few minutes down to a few seconds, and more importantly, show you the best practices for utilizing options for your trading. So those are all the things that we'll go over here today. Now, the second question I want to ask is, how many of you currently have an options agreement with your bank or your brokerage firm to trade options? Meaning, how many of you have already seeked approval in your brokerage account to trade options? I just want to get a sense for how many of you currently have the ability to trade options in your account and how many of you do not. Okay, so about half of you have voted, and it looks like at least 2/3 of you have an options agreement. About a quarter of you say you do not have an options agreement, and a few of you say that you're not sure. So we'll give you a few more seconds to complete your poll here or your vote. Okay, so it looks like at least 2/3 of you have voted here. About half of you say that you have an options agreement. Um, a third of you say you don't have an options agreement. So for those third of you that say that you do not have an options agreement, my suggestion to you is that if you want to trade options, the first thing you have to do is make sure that you complete an options agreement with your bank or your brokerage firm. So you should call or contact your brokerage firm, ask them what paperwork you need to do in order to activate an options trading account for your portfolio before you can utilize any of the tools we're showing you today and any of the education that we're going to be showing you here over the next few months. And access to tools. So with that said, let's go ahead and show you what we have to offer here, because there is a great, we just launched this a couple of weeks ago. This is a great platform for those of you that are interested in trading options. This is not just a platform. This is a full suite of tools designed to help you learn and help you execute these trades. So again, first of all of this is access to all Nordic investors completely free of charge. So you can register for your free account if you have not already done so at OptionsPlay.se. This gives you free access to the OptionsPlay platform, which I will show you in a couple of minutes. It gives you access to free bi-weekly options education webinars like the one that you're on here today, and a free on-demand options video library. So if you miss one of these live events and you want to go back and you want to view one of these recordings, or maybe you just want to take some time to go through the education, you can do so using the options video library, all free of charge. And in the next coming weeks, we're going to show you how to access cover call and short put reports for those of you that like to sell options for premium, showing you where you might be able to access the most yield on these types of strategies. You're going to get free weekly cover call and short put reports from OptionsPlay and NASDAQ. So again, sign up for OptionsPlay at OptionsPlay.se, and we will provide you with all of these things completely free of charge. And make sure that you have a chance to sign up so that you get access to all of these resources. So what I want to do here is I want to give you a quick glimpse into the OptionsPlay platform for those of you that have not signed up for this, or maybe you've registered but you haven't logged in. And I want to announce that just this week, we launched not only the OptionsPlay platform, but we also launched it in Swedish. So for those of you that prefer to see your trading platform in Swedish, you can use the OptionsPlay flag on the upper right-hand corner and change the entire platform over to Swedish if you would like. So this is a new feature we just launched this week. So if you signed up a couple of weeks ago and you were logging on and you were seeing everything in English, now you can see everything in Swedish if you would like to do that. So let's go ahead and get started here. The platform itself is really designed from the ground up to try to make options trading as easy to learn as possible. Now, almost a third of you answered that you're brand new to options trading, or at least half of you say that you're either brand new or still in the learning process. Now, we started this company because we realized that options trading is not very simple. If any of you have ever traded options, you've probably seen a page that looks like this. Now, I just want to make sure everyone has access to your chat window. So if you can pull up your chat window at the bottom of your screen and just type 1 into your chat window if you've seen a screen that looks like this before, where you have an option chain, call options on the left-hand side, put options on the right-hand side. Great, I see a lot of ones, perfect. So this type of screen was built a long time ago. Back in the 70s, when options were invented in the United States, we used to list options this way because that was the only way to look at this type of data. It was a lot of data because you have lots of calls, lots of puts, lots of expiration dates, lots of different strike prices, and it becomes a little confusing sometimes to know where to start. And many times as an options trader, not only do you have to select the strategy, you have to select an expiration date, you have to select the strike price, and on a page that looks like this, that's not easy to do. Even if you are more experienced with options trading, such as like myself, um, I have a much better sense for where to start on this page. But in order for me to analyze that choice, meaning if I think the stock is going to go higher or lower, in order for me to understand what my risk is and what my potential rewards are, that takes a lot of time and takes a lot of expertise to be able to do. And we realized that that was very, very hard to do for most beginners and even experienced options traders. And that's why we created OptionsPlay, to make the process for finding a strategy easier, making analyzing the strategies much easier, so that you can quickly make a decision as to whether you want to trade options or if you want to trade the underlying stock. So that's what I'm going to come back to in a few minutes after we go through some options education to show you how to utilize this tool. But I want to make sure everyone now knows that this is now available in both English and in Swedish for those of you that are more comfortable in the Swedish language. Now, the second thing I want to go over before we jump into the actual education itself is to actually show you where you can access some of these resources. Now, many of you have, if you're on this webinar, you've already signed up for the options education. But if you have not, I highly recommend you to register for the options education. Again, as long as you sign up for an OptionsPlay account, we will send you notifications of all upcoming events whenever we do one of these. However, what we do is we typically try to stick to a schedule of every other Wednesday at 5:30 p.m. Central European Time, which is the same time as this current webinar. And just so you know, all of the webinars that we do are recorded, and the slides for them are available to you to download afterwards, so that you can take a look at the slides and you can take a look at the recordings afterwards. So, and to access those recordings and the slides afterwards, you can always use a link here that will take you to our options education page. And for those of you that want to follow us on YouTube, all of our videos are uploaded to YouTube. So however you prefer to keep track of the education that we create, you can either visit our education page or you can visit our YouTube channel. You can subscribe to us on YouTube, so every time we post a new video, you'll automatically get an email or a notification of updated online education. So with that, one last thing I want to talk to you guys about today before we jump into options education is I'm going to be doing a live event from Stockholm on December 10th, Thursday, December 10th. Same time, 5:30 p.m. Central European Time. I will be in the NASDAQ offices. We're going to be doing a 2-hour event. I will speak for about an hour, and there will be another gentleman from from Stockholm that will be speaking. We're going to be talking about how we utilize options in our own trading, so that to give you a better sense for how to utilize options. So if you want to come to that live event, you can come, ask us questions at the end, learn a little bit more about what we have to offer. It is completely free of charge to attend. You can register using this link on your screen, which also I will post into the chat window right now if you want to register for that event and come to see me in Stockholm on December 10th, which is coming up in just a couple of weeks here. So with that, let's go ahead and get started. Just so you guys know who I am, my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. Now, I've been a market strategist for about 12 plus years. I started my career actually in foreign currency trading. So for those of you that like to trade FX, whether you like to trade dollar crown, euro crown, these are some of the more common currency pairs that I see that are traded in the Nordics. You know, I started my career learning how to trade trading currencies, which means that a lot of my trading background actually comes from technical analysis. So if any of you that like technical analysis, that is a topic that I'm actually going to cover in the next few weeks on how to merge technical analysis with options trading, but my background is really in derivatives trading, futures and options specialist, helping people better understand how to utilize these instruments to achieve their outlooks on the overall market. My background is heavily in technical analysis and quantitative trading, and I started this company in 2013 as part of the what I showed you before, as part of the need to make options trading easier and more accessible for more people. And I'm very, very proud to bring OptionsPlay here to the Nordics and show you guys how you can harness the power of options for your portfolio using the Nordic derivatives and the Nordic equities and indices that you guys already trade with the underlying stock. So with that brings me to my topic here today, which is really just giving everyone a brief introduction to options, understanding some basic strategies that you can trade. And like I said, this is just the beginning. This is meant to give you a taste for what options can do, what is the power of options, how they're different from trading stocks. And then over the coming weeks, we're gonna do much more in-depth education for each individual strategy so that you can learn more about trading those individual strategies. So we're not going to go too in depth today into any individual strategy. I will dedicate more time over the coming weeks to spend time on each strategy, making sure you understand exactly how they should be traded, what the best practices are. More importantly, we want to show you how to use OptionsPlay to actually execute these trades. So let's go ahead and get started. First, what we want to cover here today is very simple: the difference between trading stocks versus trading options. Because most of the time, if we're trying to speculate on the underlying stock, we have the choice of whether we want to buy the stock or perhaps buy an option. So what I want to do is I want to first explore the difference between trading stocks versus trading options. So whenever we're trading stocks, this is what I call simple, but very limited. So it's easy to understand, but there are limitations as to what you can do if you're trading stocks. First, your only exposure is to direction, meaning you can only bet if the stock is going to go higher or if it's going to go lower, based on whether you're going long or short the underlying stock. Now, this should be fairly easy to understand for anyone who's currently trading stocks, because you can either choose to go long the stock if you think the stock price is going to go higher, or you can go short the stock if you think the stock price is going to go lower. Now, when you trade options, you're going to this is going to become a lot more complex. There's no hiding from that. Options is complex, but with that complexity will come a lot more flexibility. You're going to have a lot more ability to structure different types of trades and get far different payouts, maybe better payouts based on the specific outlooks that you have on a stock or ETF. So when you're trading options, you now have exposure to three different things. You have exposure to the direction, which means whether you think the stock is going to go higher or lower. So if you think the stock is going to go higher or lower. Magnitude, meaning do you think it's going to go up by 1%, 5%, or 10%? And lastly, to timing, meaning you have to also be sensitive to how long that 1%, 5%, or 10% move is going to take. So right off the bat, you have to look for, instead of one thing, you have to look at three different things. Now that's where the complexity comes into play. Moreover, you have to, instead of just going long the stock or short the stock, you can either buy or sell a call or a put. So instead of having two options, you now immediately have four options. So you've increased the complexity to having four options, and now you have to think of direction, magnitude, and timing. So this is where sometimes it can get a little overwhelming for most beginners. So what I want to do is I want to make sure that I spend the time over the next few weeks to walk you through each individual strategy, show you what direction, magnitude, and timing mean, and how do you go about selecting buying or selling a call or put, what strike prices to choose, what expiration dates to choose when you're trading options. makes sense to everyone, please type 1 into the chat window. I just want to make sure everyone understands the difference, the basic difference between trading stocks versus options before we move on to talking about specific strategies. So please type 1 into the chat window if that makes sense to you. Okay, great. I see a few ones here so far. Perfect. Okay, a lot more coming in now. Great. So I just want to make sure everyone understands that when you're trading options, you're adding complexity. What we're going to do over the next few weeks is make sure we help you understand that complexity and understand how to go about utilizing in the right fashion. So when we're talking about options, there are 2 types of strategies that we're going to cover here today. Now, there are lots of different use cases for options, but 2 of the most, I would say, popular ones is generating income. That is the most popular way, the most popular use case of options. And the second one is speculation, meaning betting whether a stock is going to go higher or lower by a certain amount of magnitude. So when we refer to generating income, the most popular strategy, and the one we're going to cover first, is selling what we call a covered call. Now, you might not know what a covered call is. That's what we're here to help explain a little bit here today. But again, this is not going to be an in-depth understanding of covered calls. This is more of an introduction, and we're going to go in-depth into these strategies over the next few weeks. So selling a covered call is simply, before I've referred, you can buy or sell a call or a put. So you have 4 options whenever you're trading options. So when we're selling a covered call, what we're doing, we're selling a call option, but we're going to do it against the stock that you own in your portfolio. So imagine if you own 200 shares of H&M stock and you want to generate income. What you can do is you can sell call options against your H&M stock and receive some income by doing so. Now, when you do this type of strategy, it requires a minimum of 100 shares. So think about your portfolio. How many stocks do you have at least 100 shares of? How many stocks do you not have 100 shares of? This strategy only applies to those stocks that you have at least 100 shares of. And what you want to do is when you're selling covered calls is you want to sell an expiration date that's roughly 1 month from today, and you always want to sell out of the money calls. And this is something we're going to discuss over the next few slides, and more so in the next few weeks, what that actually means, selling an out of the money call option. Now, conversely, if let's say we're not here to generate income, let's say we're here to speculate on a stock because you believe a stock is going to go higher or you believe a stock is going to go lower, that's when we can buy a call option or buy a put option. So the bullish strategy here, meaning if we have a stock, let's say we have H&M stock and we think the stock is going to go higher. Then what we want to do is we want to buy a call option. That would be a suitable strategy to take a bullish view on a stock. Or conversely, if let's say you believe H&M stock is going to move lower, then a suitable strategy for that would be buying a put option. Now, these are simple option strategies that I will break down briefly today to give you a sense for what these strategies mean. But whenever you're buying a call or a put, generally speaking, when you're picking expiration dates, you want to buy usually 1 to 2 months away from expiration. I'll cover over the next few weeks why that's the case. But whenever we're buying options, the rule of thumb here is you usually want to start with in the money strike prices. So strike prices that are already in the money when you're buying a call or a put. Now, if you don't know what these terms mean, that's okay. We're going to start covering these to hopefully help you clear up some of these terms that you may be new to for those of you that are brand new to options trading. So before we jump into some specific examples, we tend to see that a lot of people get a little confused with buying a call, selling a call, buying a put, or selling a put. So I want to do some basic math to help you better understand what you're actually trading when you're buying a call or a put or selling a call or a put. So what we're going to do here before we can understand these strategies is we're going to assign each one a plus or minus sign. And I think it's pretty intuitive as to why a buy would be a positive sign and a sell would be a negative sign. But what we're going to do is we're going to assign a call option to the positive sign and a put option to be a negative sign. So we know calls are bullish, they're bearish. So I think that is fairly intuitive as to why calls are positive and puts are negative. And you can do a basic multiplication to understand whether you're trading a bullish or bearish strategy. So buying a call option. So we said buying is a positive, call is a positive. Positive and positive makes us a positive. So that's how you can remember that buying a call option is bullish. Conversely, and what you can do is you can sell a call option. Now, whenever we're selling a call option, a sell is a negative multiplied by a call, which is a positive. That gives us a negative. So selling a call is actually a bearish strategy. Next, buying a put. We know buy is a positive, put is a negative. So positive and a negative gives us bearish. That's why buying a put is a bearish strategy. And lastly, we were to sell a put. That's where we're selling it. Sell is a negative, put is a negative. Two negatives make a positive. So we know that selling a put is bullish. So this is a quick and easy way to help you remember which one of these strategies, what's bullish, what's bearish, and this is going to come in much more handy down the line as you get more experience with options trading and you start thinking about combining these strategies, because you don't have to just buy a call. You can actually buy a call and sell another call at the same time. And that's really how you get more advanced strategies, and that's how you get strategies that will provide you with better outcomes sometimes. So, but today we're just here to discuss the basics, and one of the most important things to remember is what each one of these strategies mean. So let's go ahead and move on to some examples. So here's a stock. This, it doesn't matter what this stock is. This is a stock currently trading around 100 crowns. Now, let's say I'm either bullish or bearish on the stock. This is a stock currently trading at 100 crowns, and I can either say I'm bullish and buy the stock because I think the stock is going to move higher, or I can say I'm bearish and sell the stock or short the stock because I believe the stock is going to move lower. Now, different people may have different views on the stock, so you can express those views by either going long or short the stock. Now, this strategy gives you immediate gains if you get the direction correct. What that means is that if you buy the stock at 100 crowns and it goes up by a single cent, you're going to make some money. Vice versa, if it goes down by a single cent, you will start losing money. This is what we call symmetrical exposure, meaning dollar for dollar, or crown by crown. If the stock goes up by a crown, it makes a crown. If it goes down by a crown, you lose a crown. It's very simple and very easy to understand. You can hold on to a trade for as long as you would like. You can hold on to a stock trade for a minute, a week, a month, a year, however long you'd like. As long as you have enough margin in your account to hold this, you can go long or short a stock. However, there is one major limitation, is that if, let's say, you don't believe this stock is going to move very much, maybe you think it'll go higher by a little bit, but maybe fundamentals based on what you understand about this company, maybe you don't think it's going to move much lower or much higher, and you think that it might just move sideways. Where it might just move sideways like this, and you don't really have a strong view that it's going to move higher or lower, and you might feel that the stock might just be range bound for a while. If that's the case, there's really no stock trade you can make that would allow you to profit from a neutral view on the underlying stock. And that's really where the power of options comes in, because you can trade neutral directional views. But before I move on, I just want to make sure everyone understands this example of stock trading. If that makes sense to you, please type 2 into your chat window. It's stock trading, example of going long or short stock and having symmetrical exposure and being able to make money instantly if the stock goes up or down once you've entered that trade. If that makes sense to you, please type 2 into your chat window. Okay, great. I see a bunch of 2s. Perfect. So now, if we understand this one, hopefully you'll understand the next one fairly easily, which is buying a call option. So a call option is the same thing. used in speculating because I believe the stock is going to go higher. So let's say this is a stock currently trading around 100 crowns, and I'm bullish on the stock. I think the stock is going to go higher. The difference between buying a call option and buying a stock is that when you buy a call option, not only does the stock need to move in the direction you expect it to, it needs to not only move in the direction, but actually move far enough in order for you to be profitable. Now, the question is, how far does the stock need to move in order for you to be profitable? And the answer to that is depends on how much you pay for that call option. So if you take a bullish bet by buying a call option, you will profit only if the direction and the magnitude moves higher by the premium that you've paid for on the call option. So meaning the stock needs to move by not only higher, it needs to move higher by a certain amount in order for you to be profitable. Now, that's the downside to buying a call option. The upside is the fact that you have limited risk, so that normally if you buy a stock that's 100 crowns, and if the stock drops to, let's say, 80 crowns, you'll lose 20 crowns per share. But when you buy a call option, your risk is completely limited to how much you pay for that call option. So let's say you pay 3-4 crowns for a call option. No matter what happens, even if the stock goes to zero, instead of losing 100 crowns, you will only lose 3 to 4 crowns. So the upside is the fact that you have limited risk. And the upside is that if the trade goes in your favor, you will make a higher return. Now, lastly, unlike a stock trade where you have unlimited exposure, you can wait 2 years for the stock to move higher. When you trade an option, you have an expiration date. So that expiration date, so your directional view or your directional outlook must happen prior to that expiration date. So it has to happen in this time frame. If it exceeds that time frame, no matter what happens, even if you're correct on that trade, you're not going to participate in any upside on that anything beyond that expiration date. So this is really, in my opinion, where technical analysis is very useful, because when I look at a chart, I can get a sense for how long I think something's going to take, versus if I'm looking at fundamentals, fundamentals doesn't account for time. So whenever we're looking at options trading, we have to make sure we balance where we think the stock will go with how long we think the stock will go, how long we think it would take for that stock to make that move. So in this example, if I have a stock that's trading around 100 crowns and I buy it for 4 crowns, then this call option is only profitable if the stock moves up by up to 104 crowns, not just going up to, let's say, 101, 102, 103. It has to go to 104 just to break even. Now, in order for this strategy to be profitable, it would have to go above 104. So 105, 106, 107, 108. The more it goes, the more profitable I am, but it needs to exceed at least 104 in order to be profitable. So if it's anywhere, one of the things that I think sometimes is confusing for call option buyers is that you have a stock that's at 100 crowns. You think it's going to go higher, and let's say it does go higher. Let's say it goes up to 103. What you're going to find is that if it goes up to 103, that's not enough for you to make money, because you paid 4 crowns for that call option. The stock needs to move all the way up to at least 104. So if it only goes up to 103, you've got the direction correct, but because it didn't move far enough, you actually still lose money on that trade. The upside is the fact that, let's say you're wrong. Let's say the stock plummets down to $90. If you had bought the stock, you'd be losing 10 crowns per share. Here in this example, you only risk 4 crowns. No matter what happens, even if the stock goes to zero, your risk is 4 crowns per share. That's it. And you still participate in unlimited gains if the stock goes higher and higher and higher. So this is the trade-off that you have whenever you're trading an option. The fact that not only do you have to call the direction correct, you also have to call the magnitude correct. And that sometimes is difficult to do. However, if you're able to do it, you can get, you're basically controlling $100 stock with just $4. So you're controlling a $100 stock, a 100 crown stock with four crowns, which means that you have a leverage of about 25 to 1. So you're trading with leverage, and at the same time, you're limiting your losses to just 4 crowns a share. And the downside and the upside is the fact that no matter what happens, the most you can lose is those 4 crowns. Now, before I move on, I just want to make sure everyone understands that difference between buying a stock to buying a call. Is that when you buy a call option, not only do you have to call the direction correct, you also make sure that you have to make sure the stock moves by a far enough magnitude in order for you to be profitable. And the trade-off that you have there is that you have a limited risk. So if that makes sense, please 3 into the chat window. Okay, great. I see a lot of 3s. Perfect. So the next one I'm going to do is it's bearish example, but it's the same thing. Basically, if you think the stock's going to move lower, not only does it have to move lower, it has to move lower by a far enough magnitude in order for you to be profitable, and the stock can continue moving lower and lower and lower, and you'll make more and more money. And the downside and the upside is the fact that if the stock moves higher, even if it shoots up to 120, 130, 140, the most you will lose is a limited amount of risk. And that's the trade-off that you have whenever you're trading options. This is the asymmetrical risk that we typically refer to options that give you a limited risk strategy, but gives you leverage if you are correct on the trade. So in the same example, if I'm bearish on this trade, instead of just shorting the stock, which can be expensive and not everyone has the ability to short stocks, what I can do is I can buy a put option. And let's say this put option on this 100 crown stock cost me 4 crowns, then this strategy will be profitable if the stock goes below 96 crowns or lower. So if it's at 96, then I'm basically breaking even. If it's at 97, I'm losing money. If it goes down to 95, then I'm making money. And the further it goes down, the more money I make, all the way down to 0. However, if I'm wrong on this and the stock rockets higher, I actually don't lose more and more money. The most I will lose is the 4 crowns. That is the trade-off that you're making when you're trading options, is you're limiting your risk in exchange for being able to take on a bullish or bearish view with high amounts of leverage, but have limited risk. But this trade must, again, just like the call option, it must work out before the expiration date. So if I have a bearish view on XYZ stock, it must make that move prior to that date, my expiration date. If it makes that move after my expiration date, then I don't participate in any of that. It means that if, let's say, the stock goes a little higher first, and then after the option expires, and then it drops lower, it doesn't matter if the stock drops to 0 afterward. I don't penny off of that because that happened after the expiration date. Now, if that makes sense, please type 4 into the chat window. Again, if you understood the call option, the put option should be fairly simple to understand because you're just flipping the direction of the strategy. Okay, great. I see a lot of 4s. Perfect. So lastly, let's move on to the last one, which is selling a cover call. Again, for those of you that have already applied for an options agreement, a cover call is the first trade that you're able to execute in your options agreement. Most brokerage firms will allow you to trade this strategy first. The reason for it is because this is what's typically referred to as a riskless strategy, meaning it's a strategy that is not adding risk to your portfolio. It's only when you sell a cover call, the only thing you can do is reduce the risk of a portfolio. That's why it's the first option strategy you're allowed to trade when you first apply for an option strategy. So let's walk you through this trade first. So selling a cover call gives you 2 primary objectives. Number 1, it allows you to collect income on the stocks that you own in your portfolio. Number 2, it allows you to take profit on the stocks that you own in your portfolio. Now, I'm going to walk you through what these 2 bullet points mean and show you how you can actually generate income and potentially take profit on the stocks that you own. So I think the best way to do that is actually show you the example. So let's say you own a stock that's currently trading at 100 crowns, and you have a target price of 105. So you have a stock that's at 100 crowns. You think that this stock might reach about 105 or so, which is about right here. So what you can do is you can sell a 105 call option, 1 month, 105 crown call option for 2 crowns. And what that provides you with is 2 crowns of income if XYZ is below 105 at expiration. Now, as you can see, if you sell a 105 crown call option in 1 month, 2 things can happen. Either the stock 1 month from today is above 105, or 2 months from today, the stock is below 105. And depending on whether it's above that 105 level or below that 105 level determines the outcome of this particular trade. Now, if the stock rallies up to 105 or higher, let's say it goes up to 106 by your expiration date, what happens is now you've sold your stock at 105, because when you sell a call option, you've effectively placed an order to sell your stock at 105. So if the stock goes up to 106, you've sold your stock at 105, but you got paid $2 to do so. So you can think of a cover call like placing a limit order to sell your stock sometime in the future, but you're getting paid to place that limit order. So 2 things can happen. The stock goes above your limit price, you sell your stock at the limit price, and you keep the $2 or two crown income that you receive for selling that cover call. Now, what's also possible is the stock doesn't go below 105. Let's say it goes to 104. If the stock settles at 104 at the expiration date, now not only do you keep your stock, you also keep the $2 income. So both scenarios, you keep your $2 income. The question is whether or not you sell your stock at 105. So this is really where it allows you to systematically take profit of your stocks as they rally. So 105, I just picked 105 as an arbitrary point. You can choose your own target prices that you have on your stock and sell cover calls at those target prices. So if the stock reaches those target prices, you get to take profit on them. But while you wait for the stock to rally, you're going to get paid income. And you can do this month after month. So let's say 1 month the stock doesn't go up to 105, and let's say it goes up to 104. Maybe next month you raise your target price to 108, so you sell a cover call at 108. And the month after that, it still doesn't reach 108, and you keep selling cover calls, and you start generating an income stream on your stock until the stock actually exceeds your cover call strike price. Then at that point, you've sold your stock at a profit. And over the previous 3 months, you've generated, let's say, 2 crowns in income for that underlying stock. And you can do this over and over again until the stock actually rises to your target price and you're able to take profit on your stock. But while you wait for that to happen, you generate an income stream. So that is, in essence, the cover call strategy. Now, I've introduced cover calls to you in literally 5 minutes. And to be perfectly honest, this is typically a strategy that I like to spend about 45 minutes on, because there are quite a few things to go into this. I'm just giving you guys a taste for what you're going to get over the next few weeks. But today, this just gives you a sense for how you can actually generate income utilizing options in your portfolio. So before we move on, I just want to make sure everyone understands basically, at a very high level, how a cover call works. If you understand that, please type 5. And if you're confused by that, please type 6. Just so I get a sense for how many users understand a cover call and how many users are a little confused. So 5 of you understand, 6 of you are a little confused. Okay, so I see a few 5s, quite a few 5s actually, a couple of 6s. So if you're confused, that's okay. This is not something that you will learn in just 5 minutes. Cover calls is something that I typically take 45 minutes to walk through, show you lots of different examples, show you OptionsPlay, the platform itself, to show you how to utilize these tools. So lastly, I want to actually go through the Greeks, and I want to go through some of the common mistakes, but I want to spend a few minutes before we close today showing you the platform, because I think the best way for you to truly understand what we have to offer you and what you'll get over the next few weeks and a few months from Options Play, from NASDAQ, from these education webinars is to actually really just show you. So what I'm going to do is I'm going to take a few minutes, walk you through the platform before we open this up for Q&A. And if I have time, I'll come back to those last two slides that are important, but I don't think is necessary specific to today's webinar. So this is the OptionsPlay platform that you have access to when you register at optionsplay.se. So again, if you haven't registered, please go ahead and do so. It's a free platform, and it's designed from the ground up to try to make your options trading as easy as possible and help you avoid screens that look like this that probably just confuse you more than anything else with respect to how to start trading options. So the tool itself is divided into three sections. You have trade ideas and watch lists on the left-hand side. In the middle is your security analysis panel. On the right-hand side, you have trading and income. These three panels are what we call the what, the why, and the how of options trading, because when you sign in every single morning, you want to know what symbols do I want to pay attention to. So whether you're looking for new ideas, which we scan every single night based on technical analysis, we can give you bullish and bearish ideas depending on where you feel the markets are moving towards. Maybe you have more of a macro view as far as where you think the market's going to go, and that determines whether you're bullish or bearish on the current market and you want to seek specific opportunities. Or if you just want to see what's available out there, we have pre-built watch lists for you. We have Nordic derivatives, Danish derivatives, Finnish derivatives, Swedish derivatives, and we have them all for you so that you know which stocks have options on them, or you can create your own watch list. You can click the menu, create your own watch list, and follow the stocks you really want to trade. And this is designed to allow you to quickly be able to scan an entire list. And I will go through some of the details of the watch list, because they're color coded to help you quickly navigate what are bullish stocks, what are bearish stocks like. I'll show you in a few weeks how I know that Fingerprint, Danske, and SEB are on the bearish list for me versus stocks like Liv, Skanska, Vestas, Systems. These are bullish stocks in my opinion, because of the fact that they have high scores and they're green versus these have low scores and they're red. So these are some of the things that I typically look for, but you can create your own watch list and quickly get a sense for a directional view. Use the security analysis panel that gives you a sense for the 1 month and 6 month trend of a stock. We also show you the relative strengths to show you how strong a stock is compared to the overall market, and then give you important information such as when's the next earnings date, when is the next dividend, and certain price action data to help you better understand each underlying stock. So especially when we talk about having an expiration date, it's really important to pay attention to the earnings date so that you know, is there an earnings between now and the expiration date of my option. And lastly, once you have that directional view, so let's say I'm looking at investor AB, let's say I'm bullish on it, you can select I'm bullish, and we will show you 3 bullish strategies. Now, if you remember from my PowerPoint, I did talk very briefly that if you're buying a call option, you want to buy a 1 month call option. That is 1 to 2 months, a call option that's anywhere from 1 to 2 months out in terms of expiration dates, and you want to buy one that's slightly in the money. Now, for those of you that know what that means, yes, you can certainly go on a page that looks like this and try to find that. But for those of you that don't know what that means, chances are you won't be able to find that on this page. So not only do we apply that for you directly on our platform, we actually show how you can compare different strategies side by side. So when you select I'm bullish, we're going to show you 3 bullish strategies. You can buy the stock, which will cost you about 50,000 crowns to buy 100 shares. You can buy a call option, which we've already applied that 1 to 2 month expiration date for you. So January 17th, 2020, 500 crown call option. which costs you only 1,425 crowns, that controls the same amount of stock as 50,000 crowns. And lastly, for those of you that are a bit more advanced, and I'm not going to go through this strategy today, buying a call vertical, where we're buying the 500 crown call option, but at the same time, we're going to sell a 540 crown a call option against that for 1,340 crowns. But today, let's just focus on these two strategies. Buying 100 shares, 50,000 crowns, buying a call option, 1,400 crowns. Now, this stock is currently trading around 506 crowns. So this stock recently had a 52 high of 517. So let's say you believe that this stock is, as you can see here, recently made a high, pulled back, and continue to move higher. That's sort of what we're seeing here right now. Let me just illustrate this for those of you that see this. As you can see, we had this strong trend to the upward, pulled back a little, and then moved higher. Notice how the trend, turned from bullish to neutral, back to bullish. And what we're seeing that again is the same pattern. When the stock pulled back, that was a good buying opportunity, and now it resumed bullish again. So what we can do is we can assume perhaps that the stock is going to continue moving higher. So this is based on my technical analysis. You may have different views to understand where you believe the outlook of a stock will be, but you can use these types of technical analysis tools to get a sense for how far do you think the stock will go. So let's say I think the stock will move to 530 crowns. That's my outlook. Now, again, this is not a recommendation or solicitation to trade this specific security, but let's say I'm buying the stock because I believe it's going to move higher, and let's say it does move higher to 530 crowns. How much money do I actually make? Now, this was the problem that we had when we were trading using screens like this as professionals, is we would have to estimate, if I bought the 200 crown call option, how much money do I make if it goes up to 210? How much money do I make if it goes up to 220? And we would have to do back of the envelope estimations to guess how much money we would make. Here, we take that guesswork out of the equation. You can simply plug in where you think the stock will go, and we will show you exactly how much you would make on that trade. So if you bought 100 shares of the stock for 50,000 crowns, you would make about a 4.5% return. If you bought a call option instead, you make 116% return, significantly more, because you're making roughly the same dollar amount here. On the stock, you make 2,200 crowns, 2,300 crowns. Here, you make 1,600 crowns. You actually make less crowns, but because it costs you so much less to place that trade, your return is magnified by a huge amount, from 4.5% to 116%. That is the type of leverage that you will typically see when you buy a call option versus buying the stock. But more importantly, I don't like to look at the outlook first. I like to look at how much am I risking? Because when I look at a stock that looks like this, that has such a huge run from, what was this, around 450 or so, all the way up to 517, that's about a 70 crown move, right? That's a big move. And as you can see, that didn't really pull back at all during that. So what if it pulled back to, let's say, 480, which is that resistance level, that prior high right here? What if it pulled back to 480? Or maybe what if it pulled back all the way down to 450 again? I don't think that that's crazy. That's always a possibility. But we always want to make sure that we understand our risks before we place a trade. What if we're wrong on stock? And what if it pulls back to 460? If it does that, if I had bought 100 shares of this stock for 50,000 crowns, I would lose 4,680 crowns. If I bought a call option, I only lose 1,400 crowns. So as you can see, even though I'm taking on substantially less capital, I'm risking only about a third of what I'm risking if I bought 100 shares of that stock. So that's why when I'm buying a call option, I'm limiting my losses. But if I'm right on my I get a substantially higher return. The only time the call option doesn't make a lot of sense is if you don't believe the stock is going to make a big move. So let's say you think the stock is going to go up a few points. Let's say it only goes back up to 515. The stock only goes up to 515. Even at 515, I'm still going to make a substantially higher return. Instead of 1.6, I'm making a 24% return. So even a small move to the upside in this particular case, this call option still looks pretty attractive to me compared to buying 100 shares of that stock. So that's how you can use our tool to quickly gain a directional view on the trade and quickly analyze a specific trade. Now, I see a couple of questions here. I'm going to just go through one more thing before I answer your question. So, Shram and Bo, I've forgotten about your questions. I will come back to those in just 1 minute. Lastly, what I wanted to show you is income. So first, I just showed you trading, which will show you 3 strategies, either bullish strategies or bearish strategies. So if we're looking at H&M, I was looking at the stock earlier. This is a fairly strong stock, but as you can see, it's had a pretty big pullback recently from its all-time highs around a little over 200 crowns. It's pulled back all the way up to 180, below this resistance level that I earlier identified around this 190 level. It's pulled back below that. So, my concern is that, this stock might maybe move, let me redraw these lines for you. My concern with H&M is that since it's pulled back significantly below this resistance level and it's bouncing back, I'm concerned that it might continue moving lower, maybe to that 176, perhaps even lower. So that's my view. So if I was trading H&M here, my views would be a little bit more on the bearish side. So I can short the stock for 18,000 crowns, or I can buy a put option for just 900 crowns. And again, if the stock pulls back to that 176 level, I'm able to use this tool to gauge how much money do I make if the stock pulls back to 176. As you can see here, buying that put option, I'm flat. I make 0 crown profit. This is an example of being correct on the direction, but not having enough magnitude to make money on this trade. So this put option is quite expensive because if the stock moves down 6-7 crowns, I make nothing on this trade. This trade actually has to move lower than 176. So if I think it'll go down to, let's say, 171 or 170, then I'll make money on this particular trade. As you can see, only 56 to 7.4%. And vice versa, if I'm wrong, which I always think that's possible. Let's say HM just rallies again. Maybe it's the holidays, they do really well. The stock rallies back up to 2,000. I'm sorry, 200 crowns. Here, I'm using 1,600 crowns if I shorted those stock versus only 900 crowns if I bought the put option. So I'm limiting my losses. No matter what happens, no matter how far the stock goes, I will lose more and more money if I shorted the stock. But here, I'm limited to just 900 crowns in losses. Even if the stock goes to 1,000 crowns, I'm still only going to risk 900 crowns. So that's how you can use our tool for quickly finding and analyzing these call and put options. And if you're ready to trade them, you just click on the trade button and we'll show you how to enter this trade into your broker's platform. For those of you that are interested in executing this trade. But before I sign off and open this up for questions, I just want to quickly show you the income tool. Now, I brought up H&M because I bet a lot of you may own H&M stock today in your account. So if you own H&M stock, you currently get paid dividends about 4.8 crowns a year, which is about 2.6% of the underlying stock per year in dividends, which is not a small amount, but I just wanted to give you a sense for selling cover calls. So selling cover calls is, again, thinking about where would you like to take profit on the stock, placing an order to sell to potentially sell your stock in the future at that price, and getting paid some money to do so. So let's say you own H&M stock. Now, I'm not going to get into the intricacies of selling cover calls. What are the different things you can look for? What modifications you can make? I will cover that on the next few webinars. But let's say I have a target price of 195 on H&M, and I'm comfortable if I sell the stock at 195. So what I can do is I can sell a January 17th 195 cover call, which means that on January 17th, if the stock goes above 195, I will sell my stock at 195. But just to sell that cover call, I'm going to pay 270 crowns today, meaning someone's going to pay me 275 crowns today to buy my stock at 190 on January 17th. Now, how much is 275 crowns? Remember, you are getting paid 4.85 per year. Here, sorry, it's not 275 crowns. It's 275 crowns for every 100 shares. So it's 2.75 crowns per share. So think about it. For every single share, you get 4.85 crowns for the year. Here, you're getting paid 2.75 crowns in just 51 days. As you can see here, this annualizes out to 10%, over 10% in yield selling a cover call. You're getting 1.5% of the underlying stock income in just 51 days versus 4.85 for the whole year. You're getting 2.75 in just 51 days. That's why when you're selling cover calls, you're able to generate a substantial amount of income for selling cover calls in strategies like this. So again, I don't have enough time to dive into the intricacies of cover calls, but I just want to show you how OptionsPlay not only helps you select the strategies, it selects an expiration date, it selects a strike price, and analyzes the trade for you so that you have all the statistics to decide which strategy is best suited for you. And you're able to analyze this very, very quickly. So with that, I just want to thank everyone for taking the time out here this afternoon, or this evening rather. I will take some time to make sure that everyone understands a little bit more about the product. So, again, this is a new partnership between NASDAQ and OptionsPlay. NASDAQ is the sole derivatives exchange in Nordic. Currently, we're providing over 100 options that you can trade on Swedish, Finnish, and Danish equities and indices. And there are a unique product specifically helping you design to manage your risk in your portfolios, help you speculate with limited risk, and generate income on those stocks. And you can trade equity options, index options, and even stocks and index futures on those NASDAQ derivative exchanges. So with that, again, I just want to thank everyone this evening for taking the time out this afternoon. Again, just to remind you, if you have not signed up for this yet, you can sign up at OptionsPlay.se, which I just sent to everyone in the chat window. And for that, now what I'll do is I'll open this up for Q&A. So if you have any questions, please type them into the chat window, and I will try to answer as many questions as possible before I sign off here for today. So it looks like I still have a few. I already have a few questions. So again, if you have some questions, please type into the chat window. Looks like I already have a question here. What's the green arrow mean? I'm not sure which green arrow you're referring to. I think it might mean. Sorry, I'm not sure which green arrow you're referring to. If you're referring to this one on the price action, let me see. I wonder if this is the one you're referring to. Are you referring to this green arrow that you currently see here on your chart? If this is the green arrow you're referring to, it's to the green arrow is to denote that this was the day that the trade idea signal was generated. So the green arrow refers to the day that the the bullish or bearish idea was generated. So you'll get a green arrow on the day if it's a bullish idea. You'll get a red arrow on the day if it was a bearish idea. Oh, it's asking, is this a credit or debit call vertical? So this is a bit of a more advanced strategy. So for those of you that don't know what a call vertical is, this is something you'll learn more about. But when you hit the trade button, we'll show you whether this is a so whenever this is trade cost that's a positive, that's going to be a debit. When you have a trade cost that's negative, that's going to be a credit. So these call and put verticals will always be a by default. Nicholas is asking, you can always use a 3-month time. You always use a 3-month time frame for technical analysis. No, you can use technical analysis for any time frame. I just tend to find that most of my trades, when it comes to technical analysis, will typically last anywhere from a few weeks to a couple of months. I usually don't use technical analysis for anything longer than, a full earnings cycle. Matt's is saying it's 9.75 crowns a year for H&M, 4.85 is for the half year. So thank you for that clarification. I'll take a look into that, Matt. Bo is saying free platform, you said, for how long? So we have a multi-year deal with NASDAQ, so I would expect that at least for the next few years, this will be free of charge to you as a individual investor in the Nordics. This is a long-term deal that we have partnered with NASDAQ on to bring you tools, education, and ideas to give you free of charge. And I will say, if you guys use it, I think NASDAQ will continue to pay for it, because what they're most interested in is giving investors access to the tool. And if you keep using it, probably means that you're utilizing it and you're trading these derivatives. If you're doing it, that probably increases the chances of them continuing to support this system. Jonas asked a great question. What about neutral strategies? So Jonas, I didn't have time to cover this here today, but as you can see here, you can click on modify for any strategy. And we have what's called a strategy constructor. So if you want to trade neutral strategies, we actually have a whole section of neutral strategies that you can create. You can create butterflies, condors, straddles, and triangles. This is all part of neutral strategies that if you want to trade, you can set them up just by the click of a mouse. You can click on modify, use the strategy constructor, and look at some neutral strategies that you like butterflies, calendars, condors, and straddles and strangles. So I hope that answered your question, Jonas. Bo is saying P&L simulator is so good. Thank you so much, Bo. We really created this because as traders ourselves, we used to use a very simple back of the envelope estimations using delta and theta to give us a sense for how much money we'd make or lose, but that was always an estimation. Here, we get a much better understanding as to how these strategies perform in any given outlook. So if you want to trade more advanced strategies, or if you just want to trade a simple call, being able to very quickly see how much money do you make or lose if the stock goes higher or lower is very, very important. And we actually use this to teach delta and theta in the upcoming sessions using the P&L simulator so that you can better understand the concepts of delta and theta and some of the other Greeks. Any other questions? Matt, thank you so much. I really appreciate that. Again, for those of you that have access to the tool, please continue to use it. We will continue to send you upcoming events and education. Again, just a reminder, I am in Stockholm on September 10th in a couple of weeks. So I highly recommend that if you have the opportunity to stop by, say hello, ask any questions. You can sign up free of charge for this event if you are in Stockholm at 5:30 p.m. after work. You can come by. We'll do a similar session to what I did here today. We'll cover some new topics. There will also be someone else speaking as well. And just come and enjoy and learn a little bit more about NASDAQ, about OptionsPlay, and what we have to offer for you guys, and it's all free of charge. Alessandro, Jonas, Nicholas, Matt, thank you so much. Per Anna, thank you so much. Raffaele, thank you so much. Really appreciate it. Any other questions before I sign off here for today? If there are no more questions, again, I just want to thank everyone for taking the time out here this afternoon. I just want to remind you, all webinars are recorded and slides will be available to you. So if this was too fast for you, if you're brand new to options trading and you need the time to review, make sure that you take a look at the recording and the slides. Subscribe to us on YouTube so that you get access to the video uploads as soon as we upload to our YouTube channel, and take a look at the options education page if you want to take a look at what other videos we've already produced for you guys to help start you off with options trading. So thank you so much. I hope you guys have found this useful. I hope you guys have a great evening. I will see you guys here in a couple of, I'm doing another event next week, and I will be in Stockholm the week after that. So I hope to see you either on a webinar, or I hope to see you guys in person in Stockholm. So thank you so much. Have a great evening, and I'll see you guys next week.